All right, good morning and welcome back to the Money Advantage podcast. I'm Rachel Marshall, and it is my pleasure and honor to bring Joe DeFazio back to the conversation today to really talk about infinite banking from a perspective of really helping you understand what it does in your financial life. And we started this conversation, Joe, a couple weeks back, comparing infinite banking to an airplane and the perpetual tailwind that you get when you have this powerful force behind you. And so we're going to dive back into that. Thank you so much for being willing to not only share the conversation at all, but being willing to come back and have this follow-on episode where we can really continue to dive into these concepts.
Oh, I'm so happy to be here and thank you for the opportunity. I will say I watched the video, and I would like to clarify a few things that I received feedback from some trusted people that I should touch on before we jump into new material, if that's okay. Um,
Absolutely. Absolutely.
okay.
So we're going to go ahead and dive in. If you have not watched the previous episode, it was called something along the lines of turning your financing costs into a perpetual tailwind. That was part one. This is part two. So if you're a little bit lost in what we're talking about, we're going to bring you up to speed today, but also go back and check out that previous episode. It's going to give a lot of context for what infinite banking is and how it adds this power or turbocharges your financial life. And Joe, I think it would be helpful as well, just because sometimes we have people jumping on who maybe have no idea what any of these things are that we're talking about. I want those people, if you're listening right now and you're saying, what is infinite banking? What is a perpetual tailwind? What are financing costs? Why should I listen? This is a concept that is going to change and revolutionize your financial life and give you an advantage that you probably have not seen otherwise. And it's so common, it's so simple, it's hidden in plain sight. And that's what we're going to be revealing to you today. So, Joe, is there anything you'd like to share at the very beginning, just context for that person who maybe has no idea what we're talking about yet?
Yes, so I actually there is because go through this. You're I'm going to skip around now because I have a slide on that that I was going to go over. But for those people that have never heard of this and tuning in for the first time, let's jump to this. Okay, share my screen. Everything Rachel just said is so accurate. Oh, is that sharing yet?
It's not. It says you're sharing screen, but I don't see anything on the screen.
Yeah, my screen kind of went black for a bit. No, maybe. Yay, nay.
Okay, I'm not seeing anything. So bear with us with, oh, there we go. You're up. You're
Oh,
live.
okay. All right, we'll go slow then. All right, so for the people who have are just learning this, the first thing I would say is you this concept there's a product, there's a contract, and a concept, right? We're talking about the concept first, and then we can talk about the product or the contract. The concept is the idea of banking, and we're all banking all the time. We've always been banking. This slide will fit better when we revisit it in a little bit, but this kind of hints to that once upon a time, you started a system like we're going to discuss all on your own without even, with no one even really telling you how. You chose to put 100% of your cash flow through that system, right? Your bank account once started with $0. And then you went and got your first job and worked for a while, and then you got paid. And you put the entire amount into that system, right? You eventually set up direct deposit. You eventually added bill pay services probably, or automatic debits for all your bills and subscriptions. Um, you had to set up your own debit cards. And so you spent time setting up this system so it's very convenient for you in your life. You already set up a system like that. All we're saying is there's a way you can set up a similar system, or actually not similar, a beneficial system where this
Mm,
system is set up to benefit someone else. You definitely get convenience out of it, and you'll definitely get some type of, like, maybe an interest rate or something like that out of it. but the lion's share of the benefits go to someone else. We're saying, can we set up a system that benefits you, your family, your legacy as the lion's share benefactor or beneficiary of the system? That's like the crux of the concept. Can we shift from the system you're already using to a system that will benefit you instead of someone else? Now,
Joe, I
uh,
just want to comment on that real quick because I think sometimes it can be so easy to be in a system and you don't realize the system that you're in. I mean, it took us a bit from being infants and children to grow up and recognize that we live in an environment that there's oxygen molecules all around us that we're breathing in that are sustaining our life, and that oxygen is going into our lungs and is exchanging inside of our body to carbon dioxide, and it's flowing through our body. It's providing this energy to our muscles. Now, all of that's happening as we're a brand new baby. I mean, part of the, the circulatory system is even in utero already, but you don't recognize the environment that you're in until you have an awareness of how things begin to work. And so, Joe, what you've just described is potentially something that you have never considered before. We just do these things automatically because it seems like this is the way to do things, and we're participating in a system without recognizing what is exactly happening. And what Joe has just done for you is helped you to zoom out from participating in something to looking at this 30,000-foot view, which is going to be even more relevant through this whole airplane analogy that we're having here today, that he's helping you zoom out and look at what's actually happening, watching yourself in this banking system that our world operates in, and seeing what the flow of money is doing to your personal control.
I couldn't have said it better myself. I think we can end right there. It's done. Yeah, it's the you were talking about like when you're a kid, you don't realize these things, and then when you're going through school or some type of education process, you learn about what things are made of, like the molecules in the air, and it's like the fish in water doesn't. They're the last person to realize that there's water. It's like you have to become aware of what's happening around you for this to make sense. I threw there's a lot of movie references in here. I added in, but this is Yoda. You must unlearn what you have learned, or you must be willing to unlearn what you think you know. Because as long as you think you know something, you can't improve upon that. You're too rigid in your thinking to improve. Um, so the main problem with this, that I said there's a lion's share benefit that goes to someone else. And we don't even, it could be the bank, it could be the bank owner, it could be a finance company. Like it's someone that's not you is the point. That here, let's go. We're just gonna skip around today, I guess. Like what?
That's okay. And if you wanted to go back to where you were going to clarify things for last time, that's fine as well. I think it's really helpful if you have questions now about banking, the banking system, infinite banking, anything that we're discussing today. I would encourage you highly to drop those questions and comments into the comments section if you're on YouTube or Facebook or LinkedIn. We'll see those comments and potentially be able to respond to them today or after the episode, because many people comment as well after the episode is live. And what's beautiful about that is that you are providing us with questions that are on your mind to be able to answer, whether today or at some point in the future. And so we would love to be able to help clarify things that potentially could use a little bit of clarification or things that just don't make as much sense to you. So please comment, please like and share this if you're joining along as well. So Joe, go ahead and jump into wherever you had planned to this morning.
Yeah, well, I just want to for the newcomer, I just want to give them the one learned piece of context that will help
Awesome.
this whole series. The idea is, what's the problem with the existing system you're using? And if you haven't, please pick up Nelson's book. It's you'll have to read it like 5 times. It's Becoming Your Own Banker. The fifth edition. Yep, there you go. Rachel has it up there. Black book. It looks like a safe vault. Um, the fifth edition. And take your time, go through it, mark it up, write down questions as you have them. The problem he highlights, people often like limit to this idea that only that they limit it to say it's 34.5% of your total pay, your spendable dollars is somehow flowing to, for example, banks. He uses interest and financing charges, and that's where that 34.5% comes. He took the average American, the average budget, the average financing, and calculated to say, on average, Americans are letting 34.5% of their spendable dollars benefit someone else. If we can recapture that, wow, what a difference that makes. But it's not limited to that. He was using that as a tangible example so we can get our arms wrapped around it. The truth is, every dollar you have faces the same problem. It flows into your hands, and if you don't deliberately divert that somewhere to something you control, it will flow out of your hands, and you have lost the benefit of those dollars forever. Your future generations have lost the benefit of those dollars forever once you've spent. So therefore, we could say all spending is borrowing from the future, right? We're always doing this. Every time we're spending, we're borrowing from the future. You're either borrowing, literally borrowing from a bank, right? Debt that you have to pay back into the future, or you're borrowing from yourself by way of foregone growth and interest and dividends and such. You're always borrowing when you're spending. And here's just to kind of solidify that. When you're borrowing from a bank, you borrow the principal and you have to repay the principal and the interest. And because you've given those dollars to someone else, you lost the interest on the principal and the interest forever. Right? The dollars that you have given back to the bank, they're gone. And all the growth attributed to those dollars forever is gone. Even if you pay cash and you pay principal, you've lost the interest on the principal and you've lost the interest on the principal and interest. They are two halves of the same coin. And that's a lot to get your mind wrapped around. But that's why I put this little column that says you can easily identify, you can see the interest charge. So we instinctively understand that version. And I think that's why Nelson went to debt first, because you can at least see 2/3 of the problem.
Mm-hmm.
Right? The unseen, it's so challenging to get people to realize once you pay cash, the bank's not paying you interest on those dollars ever again. That may make sense, but like to extrapolate over time, it's really hard to say, well, then how much did that actually cost me? And it helps to say, we normally think when we pay cash, we're using a set dollar, like $1 we're spending. Instead, think of it like an income stream, a cash flow. When you spend the dollar, that and all the growth attributed to it is also spent. And he says, if you pay attention to that way of thinking, that will be very helpful in clarifying what we're doing here.
Now, Joe, I think something that's interesting that I've never actually seen before when it comes to this conversation that bears saying is that often I think we see dollars, we see money as transactional. We just see them as I earned them for my work. I will pay them for what I need. And we see them as a uh, just a unuseful, really, except as a means to an end. The end being, I want the benefit or the reward of whatever I spent the money on. I want that new pair of shoes. I want that pizza in my mouth. I want to have a beautiful home over my, a beautiful home that I can live in. And I am trading those dollars for the things that I actually want. Now, I'm not saying we need to love money more or we need to put all of our attention and mind on money, but I think the challenge with seeing it as just a exchange to facilitate the transaction of something else, the challenge with that is we don't see what it has the potential to create for us because we're just going from, I mean, our mind kind of skips over I'm gonna say it probably a mistake mathematically, so any math nerds are gonna punish me for this, but if A leads to B and B leads to C, in our mind, A leads to C. And so I worked, I got money. A, I worked. B, I got the money. B, I have the money. It leads to C, the things I bought. I kind of just, cancel the money out of the equation. I don't even think about what it could do for me if I considered how to do that better. And I just think I worked, it gave me the food, the house, the car, the lifestyle I needed, and I worked for the lifestyle. So what we're asking or what we're saying is that there's another component, there's the mortar between the bricks of I worked and I used the money. And how can we look at that differently? This thing that's not just facilitating transactions, but has the power to, if you control it and you keep it and you think differently about not what you spend. We're not advocating that you have no lifestyle or you don't spend any money. That's not the point. The point isn't never using money. The point is, how do we use it most efficiently and effectively so that it can do more than just be spent and gone, losing the potential that it had to create for us?
Oh, I love the last piece of this. Please notice I didn't say it. Rachel said the positive, like this is not about limiting what you're spending. It's not about what you're spending on. It's not about what you're spending on. This is about how you're spending. That's why I started by saying you're already in a system. You're in the water as the fish and have no, like you haven't noticed this before. And we're talking about the plumbing and the framework and the platform of how you actually spend, how you do it, not that you do it or what you do it on. Not yet. We can get to that, but much more important, which will drive much more, um, drive the stress, the financial stress in your life way down is if you control how you purchase. Um, I hate to interrupt. Like, I hate to jump all the way back to the
Go ahead.
recap, but okay. So, all right, let's start there. So, hopefully, the newcomers, you have a little bit of a framework there. We're talking about a platform. We're talking about two systems. It's like, and then we're paralleling this to how to use specifically participating dividend paying whole life insurance from mutual companies on how to use that to best orchestrate this. Just some housekeeping. If you do have the book and are looking to follow along, again, the airplane example is found on page 17 and 18. He talks about that average budget I mentioned, and he parallels the way the money is flowing to headwinds and tailwinds in an airplane. And you can read his description there. I'm going to skip to this piece. Sorry. So yes, air traffic control is kind of like your team around you. You shouldn't feel like you're in this alone. Although you can be in absolute control and have absolute autonomy, you have a team with you. You should be able to rely on professionals to help you navigate these airs, so to speak, these waters, so to speak. Um, so I want to again emphasize this that there's a contract, right? And then there's the concept. The concept is a lot like starting a business, right? And I should have done this in the first one. I apologize. But getting in the travel industry, it starts with studying the aviation market and understanding it, the growth, the trends, the requirements, the mechanics, the operations, so on and so forth. Financially, it's extremely capital intensive. It requires like you have to lease or purchase aircraft, the hangars, set up the infrastructure, hiring and training, so on and so forth. It's like a business, okay? Not unlike a bank charter. You have to obtain a certain certificate. You have to go through rigorous, extensive documentation and compliance and waiting and so on and so forth. There's also licenses to be able to fly in every country that you want to fly. It's just like starting a bank, a little brick and mortar Bank of America type bank. There's a long process. That's the capitalization phase of getting this thing off, off to the races. getting in the travel industry. Um, when you first get in, whoops, spelled that wrong, travel industry, you may have to start small. Fewer planes, smaller planes, shorter flights, less passengers. You may have to play multiple roles within your enterprise. The pilot, the CEO, maybe a steward. Like you may have to do a lot to get this thing going. But eventually, you build brand recognition and loyalty that can help you sell and exit the business late in life. Keep that in mind as we're going through this. You're going to see the maturation of a banking system based on whole life policies that mimic the idea of being able to sell a business late in life. Um, Once you start this airline, would you ever choose another airline? Would you ever fly on another airline? Probably, I would hope not, because every ticket purchase builds the enterprise value of one of the airlines.
Not
Somebody's
to
getting the
mention, not to mention the loyalty. I mean, can you imagine CEO of
yeah,
Southwest Airlines flies on American Airlines? I mean, that's just not really probably good publicity, right?
it's terrible. The optics are horrible. Exactly. So yes, there's that. That could damage your brand and future sale price. Like why is he traveling or she traveling on that other airline? But every time you use the airline and you actually pay the ticket price and fly on your airline, you're increasing the enterprise, the book value of your business that you plan to sell one day later. So you shouldn't be afraid to use your airline. Whether you're going to fly or travel anyway, you might as well use yours and get the lion's share benefit of an increased enterprise value. Um, Keep in mind that the travel business is not the airplane. That's kind of what I was saying. The system, the concept is not the contract. It just happens to be the best vehicle to achieve the goal. If our goal is to run, a highly efficient travel industry, right now airplanes tend to be the fastest way to get across the country. um, one more piece here. I wanted to link the characters in the play to kind of like the characters in the industry we have here. Someone's going to own the airline. Like you're starting an airline, you're the owner. You're going to need staff, right? You're hoping to attract passengers, and really, the passengers sometimes are the ticket purchasers, but you also want people buying tickets from you. And it's kind of loose here, but it parallels to what Nelson lays out. The bank owner, the staff of the bank, the borrowers, and the savers. The borrowers, the passengers, are the ones that make this whole thing go round. If you don't have borrowers, there's no profit. There's nothing. You don't have passengers flying on your airline, you're going to be out of business pretty soon. So I wanted to link this back to some of the other concepts in his book before we kind of jump back into where we were.
This
Any
is
thoughts there,
perfect.
Rachel? Before? Okay.
No, I
Okay.
think this is really good. I think you've got a lot of parallels because in his book, Nelson Nash lays out the grocery store example, which is basically what you've done in a different industry. And I think what's most powerful to think about is that you do have that huge capital outlay at the beginning of starting any business. If you right now go to purchase a business, you're going to have some capital up front that is going to need to go into that in order to get off the ground. Any industry. I mean, I was just playing Monopoly Junior with my daughter this morning and she won, so she was really excited. But I think what is exciting is that you have to pay something in order to reap the rewards of that business ownership. And we skip over that when it comes to building our own financial banking system, but you need to value that capitalization. I love how you have laid this out really, really well, Joe.
Also, and just to take that a step further, it's not just business. So some people, if you're watching, you're like, I don't want to buy a business. It's not limited to just business. Like think about, did you go to school? Right? There was a capitalization period before you got your degree.
Hmm.
Right? You had to wait several years and go through several classes and before you can then say you have the degree to get to reap the benefits of the degree. Even if you had all the cash to pay for the degree on day one, you don't have the degree yet. There's a capitalization period. You have to go through a timeline to get to the benefit.
So basically, what you're
Um,
saying is there's a rite of passage to get to the reward. And
yeah,
what you're saying is true in every area of life, everything that you ever worked for. I mean, muscles, a lean body, healthy, I don't know, an ability to run a marathon, having a child, all of these things have, maybe we don't think of it in terms of money, maybe we don't think of it as a capitalization phase, but there's a preparation that's required in order to be able to do that thing or call yourself that thing or achieve that level of whatever it is that you're trying to do. And if you want to own the banking function, there's a process of preparation that you need to do in order to be able to reap that reward.
oh yeah, that's so good. It's and people want to like make the switch overnight. They're like, okay, I'm all in. Let's go. And it's like in Nelson's book, he let's see, what's the chapter called? Use it or lose it. Page 35. He talks about trying to implement too quickly or trying to do too much too quickly. So unfortunately, what Rachel just said is there's a rite of passage. Like you might be able to go run a marathon or an ultra marathon today, having never run or trained in your entire life. You might live through it too. Was it
Maybe.
effective? Was it efficient? No. Like there's a natural way to build momentum, and as you build momentum, you will expand to the point where you hit whatever you were trying to hit. In his line of thinking, there's a quote in the book where he mentions once you understand the concept, it's not unrealistic to say I want 100% of my cash flow that was going to that system to go to this system. So if the goal is the maximum, that's the maximum. 100, whatever your income is at whatever age, 100% flowing through the system. You can't do it on day one. And if you did, you'd be cutting your nose off to spite your face. You'd be sacrificing certain things that you don't understand long term to be able to make that happen. That once time passes and you get later in life, you're going to regret doing it. It's like it's like somebody has all the money to go to school and behind the back alley is like, hey, could you just print me the degree? Here's the money. And they give you the degree and you walk around saying I have the degree and get the job and then someone does a background check. And like, wait a minute, 15 years into this, you don't have a degree. Not only are you fired, your career's ruined.
Mm-hmm.
Right? So it has this rippling effect through time. It appears efficient early, but there aren't any ways to cheat this.
And
Like
I
that,
think just to go ahead.
oh, I was going to say I haven't met an actuary that has lost a nickel. I think that's a
Yeah.
Warren Buffett quote. No, but they don't lose. Like you're not going to win. There's levers to pull. And when you do one thing, I think Bruce says this a lot too. When you pull one lever, something else must give.
Hmm.
Just because you can't see it, it's not in your purview right this moment, doesn't mean it didn't give.
Hmm. I think Joe, part of where you're going with this, and we had a little bit of a text conversation over the weekend, and I think part of the challenge can be when you recognize the value of infinite banking, the temptation as you're expounding so clearly, Joe, is, well, I really do want to get to that 100% of my income into the infinite banking so I can get these advantages as quickly as possible. And the challenge is, I mean, just in all practical terms, if you put today, say you make $100,000 and you literally pay $100,000 of premium into a life insurance policy, you're still going to have to pay for your house, your food, your living expenses. And let's just say that you borrow that capital out of your policy. You're going to be in a position that you have no cash flow, you have no more income to repay those loans if you just jumped in all in today with 100% of your income into life insurance or into infinite banking, let's say. But the value of growing this system that you have more and more control and more capability and more cash value and more death benefit, you are in a position of tremendous advantage. And so I love this process that you're walking us through, Joe, to not only recognize that value, but then also to be able to see a path to get from awareness to maximum use.
Oh yeah, and early on, these a life insurance policy, it's about pooling risk. It's always about pooling risk. But early on, that's like the main benefit you're getting is pooled risk. As time goes on, you also get pooled benefits, right? You're it's not just the dollar that you pay that is driving this, right? There's a secondary behind the scene player involved. That's in Nelson. Oh, I'm glad it's still up. The bank staff is like the home office of the life insurance company, the portfolio managers of the life insurance company, right? They're working diligently with every dollar you give them. They have to. By law, they have to. They have to put the money to work. Money must flow. So early on, yes, there's incomplete or partial liquidity early on. But the trade-off is later there's a leveraged liquidity that you otherwise wouldn't have if you just put it in a bank account. Like you're not just getting the dollars you put into this back. This isn't like a you know, like Monopoly when you pay and then you get the money back. Nothing's added to the pile. Whereas the pooled benefit of the actuarial science and the portfolio managers that are the best risk mitigators in in the world are in this industry. That's what they do is mitigate risk. You know, man, I'm going down the rabbit hole here, but so people will take these policies and try to compare them, and they compare based on rates and rates of return. It's natural to do that. We're all almost trained and brainwashed that that's the best way to do this, and it's not. At least if you're going to go down that rabbit hole, please make sure whoever's quoting you a cash on cash, an internal rate, a whatever rate of return they're picking and presenting to you, make sure there's a risk. There's something they're talking about risk too. Okay, it's the risk adjusted returns that drive the portfolio that drives your contract. Risk adjusted. That's really important when we get, I don't know if we're going to get to today because we're pretty late, but like the policy loans, what that allows the insurance company on a risk adjusted basis is unlike anything you can get in the marketplace. Just to give you a preview, like it's like negative risk, lots of return. Negative risk, lots of return. Not low risk, not minimal risk, not good amount of risk. It's like negative risk on their balance sheet and lots of return. It's better than risk free for them.
I hope we
Um,
can get to that, Joe. So
as yeah.
I'm going to let you go. You go
Okay.
ahead and take it where you were planning to today.
Okay. So I'm going to skip through a bunch of these slides.
While you do, Rob Brayton says, as Nelson says, everyone should be in two businesses. The cost of not getting into the banking business is 35% of your after-tax income for the average American.
I like it.
The cost of not getting into the banking business. So thank you, Rob.
Rob, just to throw a little challenge flag, it's not just that. What about the growth on that 35? It's the 35 and whatever that 35 or whatever, 34.5%, whatever grow to for your family and your legacy. It's a lot bigger than that. Yeah, we're gonna skip through this. Where were we? I think we were down here. We were talking about this environment. And that's the next
Mhm.
piece I wanted to share is I forgot to mention the whole point of this was to explain the different environments and to say you have a choice like the everyday person who's unaware, the fish in water, so to speak, from earlier, is just trying to get ahead. They're not even aware and paying attention to what's happening to their cash flows. So they're doing a great job. They're squirreling away 5, 10, what have you, percent of their income. Meanwhile, they're ignoring the fact that 34 and a half, that's what this represents. We just moved the decimal to make the math a little easier. But this environment where, let's see if I can get this to play. I did last time, I think. Come on.
Yep.
Yeah, there we go. It's like you're flying into this terrible wind that's throwing you backwards. It's like great, you got your 10% grew 10%. So you have 11% now when 34 and a half is throwing you backwards. It's like the volume is more important than the rate. And that's what he's trying to drive home here. The volume is more important than the rate. And we're going to talk a little bit later of how to expand that. Um, but for right now, do this example. Take, which would you rather have? The rate of, you pick your percent, 50%, or would you rather have 10%? Almost everyone instinctively thinks, well, duh, I want 50%. If you took that 30,000 foot view, you would say, of what? 50% of $1 is 50 cents. 10% of $1 billion? Which one's greater? Like, I'll take 10% all day long on a larger volume. Volume drives that equation, not the rate. We're so accustomed to being in this hostile environment where we think we only ever have to choose what to do with the 10%. And so automatically we discard any talk about the volume and say, I have 10%, so I guess that's all I can do.
And Joe,
Or
just for clarification purposes, when you're saying I have 10%, that's saying how much money can I save? How much money
yes,
am I not spending today? What small, tiny sliver slice of my total income is the whole thing that I can put aside to the future, and that's all we're having a conversation about, that little tiny portion, and Joe's saying the 10%.
yes, my apology. Like if we had $100, we're talking about $10. And you're saying, well, if I have $10, I only have $10. So that $10, it can either earn 4%, 5%, 7%, 10%. So the $10 at a maximum can earn one extra dollar. 10% of 10 is one extra dollar. No way. How that's where all the comparison happens. We assume the same scale, and then we say, well, let's just compare the rates and bigger numbers better. I think that's a Ryan Griggs quote. Bigger number, better sooner, or something like that. He's got to get that he's got to get that trademark. But what if we just took a larger view here, a 30,000 foot view, and said, well, if there was no headwind, right? If we wait, there's no headwind, we took care of our debt, we're moving forward like at a much faster pace, right? Because we have to net out. If we're giving away 34 and a half, $34.50, and we're saving 10, well, we're really still at negative. We're moving backwards. We're still negative. If we're not giving away the $34.50, we're moving forward at 10. So we're moving forward, we're just crawling. What Nelson realizes, if we choose an environment that helps us, man, we can take the 10 and add it to the 34.50 to get 44.50. To go from one environment, the negative hostile environment, to this positive friendly environment is a 600, 700 mile per hour swing. You can't make up a rate of return that can beat saving 45% of your income. You just can't do it. The scale is too large. The volume is too large to make up in a rate of return. You're putting way too much pressure on the smaller scale, on the smaller volume to try and overcome this. You would take
So,
on, oh God,
you go ahead.
no, you would have to borderline gamble to make that work. You'd have to go to a casino to try and make that work. And it's most people don't want to do that with their life savings. So he's
Joe, I was just
saying,
going to say what's interesting here is that basically, if we had to take off the airplane analogy for a moment and look at what we're talking about financially, if you ignore the debt cost of 34.5% to the average American, maybe yours is a little higher, maybe it's a little less, but the 34.5% of your dollars that are going out the door to interest, if you ignore that and you just try to get your savings of maybe 10% of your income to move you forward, that's a negative environment where you're still going backwards. You're not actually going to compensate for the outflow of interest by getting a little bit higher return on that skinny sliver slice of savings. To move to the uh, neutral environment where there's no cost of interest flowing out, maybe you can get that 10% of your income to do something a little bit better if you didn't have the drag of the interest cost on it. But the best situation is to be in a position where your 34.5% of your dollars that was flowing out to interest to other financing institutions is instead being used towards building your own banking system along with that 10% that you were saving, meaning that you've got 44.5% of your income, which is nearly half, working for you rather than part of that pulling against you. And you're saying, Joe, that when you have a bigger volume of dollars that you're using well, instead of just accepting the limitations of the typical banking system and the thing that I normally operate in, where I pay everyone else, the bank and the mortgage company, for capital that I don't have, instead of operating under that landscape and that environment, let's switch the environment to be in a position where you own the cash and you control it. So you're able to define the terms and you have a much larger slice of your financial pie working for you.
I love that. Yes, that's a great way to really, really drill down the volume versus the rate. If, and I'll just make a little bit a tweak here. You're partnering with the life insurance company, right? You're not borrowing from your policy. You have found another person, another entity that's willing to work with you on the most favorable terms out there, period. They're willing to give you an unstructured line of credit. They're really like it's almost like a line of credit with a rewards package attached to it, right? That you dividends that flow through like you are an owner and the borrower. You're sitting on both sides of the table. So it's like you're on the same side. You're always on the same side. So they treat you so much better. Whereas if you go to a bank, you're always on the opposite side of the table. What's good for you is inherently bad for them. The interests are not mutually aligned. When you're in a mutual life insurance company with a participating, a dividend paying whole life, your interests are as close to perfectly aligned as you will ever find. That's part of the magic here of why it works. They're not cutting you, in because they like you. They're doing what's in the best interest for the owners, but by signing that contract, you also become an owner. You're like a limited partner. You just receive the dividends. You're not involved in the operations. You don't have to go to board meetings. You're not like making decisions like that. You're just collecting all the benefits, the lion's share of benefits. I love that. Um, Nelson, his lesson is choose the environment wisely because that's what dictates how stressful the rest of your financial life is going to be. You could stay in the system that you have built or are used to. It's like this barren desert over here, or you can come to greener pasture. And it's I like this image because it's like a gradient. It's like a transition. You can't just jump from that one to that one. There's a transition period, right? In the beginning, you're doing 100% in the old system, right? As you make the like you're gradually shifting to the other system. Eventually, you'll be 100% in this system, but you still have to use the old system till you get there. Um, yeah, that's good stuff.
That's well said, Joe. That's back to the capitalization phase or the rite of passage, the preparation to be able to earn that thing.
Yeah.
And Rob said he was on a delay. He had to pause. So great point about the growth of the 35%, Joe. So he noted that.
Thank you, sir. This we already kind of went through these, but this is why I'm saying it's not limited to the 34 and a half. Exactly. That was a perfect timing. The 34 and a half also has a cost associated with it, right? And it's not just that much of your income, it's your entire paycheck flows into your hand. You get to decide what to do with it. Right now, unbeknownst to you, you have a choice. You just put it in the bank, or you cash your paycheck and stick it in a can on your dresser. But it still has this problem. The minute you spend it, this problem, it snaps right back into focus. If you spend it, it's gone forever, right? That's hopefully this makes a little more sense. The scene, it's easier to see. We hate debt. Everyone hates debt. Debt isn't only negative if you don't have control or influence over the person you're borrowing from. And the collateral you pledge is not guaranteed by that person or entity. That's the only time it's dangerous. Think you go to a bank, you're promising, to repay them. It's their money and your money. Like you're borrowing from them. You have to pledge your FICO score, your future income. You have to pledge the house that you're borrowing against, right? They give you the money so you can go do these things. That's why you understand the interest component is so negative in that position. If instead you owned the bank, would that be bad? It's like taking money out of your left pocket and putting it in your right pocket. Is that really that harmful to you? No. In fact, it's extremely beneficial because your money continues to compound and scales, right? One lesson that it came to, one that I realized through my formal training is compounding is thought to be driven by a rate. Well, we just proved the rate isn't as significant, right? If you had an infinite rate but no volume, the rate doesn't matter, right? If you had a little bit of volume and a little bit of rate, I'm sorry, if you had a lot of volume and no rate, you still have a lot of volume. It's like the volume's more important. If you can get you can even say this with compounding. Compounding is time, scale, and rate. Well, we just said the rate doesn't really matter. And you could say the same thing with time almost, which is crazy because everyone thinks that's the biggest benefit. If you have no time but a lot of volume, it doesn't matter.
Mm-hmm.
If you have no rate but a lot of volume, it doesn't matter again. But if you have infinite of both time and rate but no volume, the time and rate are useless. The most important thing in there is volume. And what this allows your capital to do is constantly compound, scale, volume. I'm thinking, how are we doing on time?
Yeah, Joe, that's a really powerful concept. And we're fine on time. If you are good, I sent you a message here. If you want to go about another 10 minutes over, I'm okay with that. As long as you are.
Okay, yeah, let's keep going. I don't even think we got to some new stuff, but this is another visual of this for people struggling with this concept, not understanding what we're talking about. You've ever seen Endgame? It was a pretty big movie a while back. Tony Stark, the Hulk, all those guys. There's a scene in there that visually does this so well. When you're borrowing from someone else, at first they give up their capital. This is the scene when someone's giving the time zone to the Hulk and showing the repercussion of that choice, this red arrow. It creates a deviant future right? Where they don't have the time stone anymore, which is very problematic in this movie. You have to watch the movie. It's beyond the scope of
I
this.
haven't seen it. It looks awesome
But
though.
right. So there's a new future because they gave up the time stone. And what ends up happening is this gentleman here, the Hulk, realizes, well, if we can time travel and give you the time stone back, does that fix your problem? And it does. That's what's happening when you borrow and repay another person. The problem creeps in if you borrow from your own future, meaning pay cash, you can never make yourself whole. Even if you use, like, let's play this out. You earn a dollar, you store the dollar, and then you spend the dollar. Well, if you spent the dollar, you don't have it anymore. Well, oh man, we earned one and we have zero here. I'll just earn another one, so then I have one here. But you earned two, and there's still one missing. I'll just earn another one, and I'll save that one. There's three and two, there's still one missing. Forever, there will be one missing. Every time you purchase, there's going to be one missing. That's essentially what I'm saying when you're borrowing from the future of yourself. If you start adding that up with every purchase you make, the cost, the unseen cost, is astronomical when you understand this concept. Nelson realizing the only way to win is if you can create this, but you're the benefit. Like you're both characters. The only thing that can do that right now, to date, right now, is life insurance. Now that let me stop and pause there. That doesn't mean you can't still implement parts of this concept less efficiently by using something like a HELOC and your house and the bank. But notice how I keep saying and right? You can do a brokerage account with the financing custodian you're at that has a bank relationship that will allow you to collateralize it. You could do it there too. And the more people you say and, they're in front of you in the line of decision making. They have control over your account or your house. They get to call the shots if anything. If they get nervous about anything, they say we're going to liquidate everything and I want my money back. Like when you realize this friendly, greener pastures, the friendly environment, the positive environment, they never call you because you are the owner. So they trust you to make the call up on yourself. Whereas over here, there's multiple people involved ahead of you. This becomes putting yourself in front of the line in absolute control. We got
Joe,
another
that's
couple
awesome.
minutes. Oh, thank you. Yeah. Um, if we go back to the airplane example, we were saying here, I think this is kind of where we left off.
Mm-hmm.
This idea that 100% of the volume of your cash flow, like your whole salary, could eventually be premium. If you had the system that was mature, you've paid the rite of passage, it's mature enough, you can pay 100% of your cash flow through the system and still be able to spend on the other side. That sounds foreign because it is in the current environment you're in. You don't receive the lion's share of your efforts. So you're constantly at this disadvantage. You're constantly starved of access to capital. And as Rachel so eloquently put, I think you said it was dollars are transactional in this environment. Dollars are like eternal, perpetual. They're so valuable in this better environment, in the friendly environment. They never go away. They just keep earning and earning and earning for you. As the scale gets large enough, you can kind of visualize this. When you're constantly resetting the scale because you're paying cash, your scale never helps you. But if the scale was constantly growing, if the volume of your dollars was constantly getting bigger, And we just learned the rate doesn't matter because eventually the rate times a big enough scale will equal the number you need it to. The scale will contractually get there at some point. It just depends on how much premium you're willing to pay early on. So eventually, the big number times the little rate becomes the number you need it to be to make this all work. But you can't jump to that. That's the rite of passage. So I said, you must unlearn what the way it's like the physics of money that you have learned is only relevant on this weird planet that you've been stuck on. We're going to a different planet where there's new rules, better rules that are in favor of you, in favor, putting you in the front line, putting you in the driver's seat. You're the pilot, you're the in control. If you opt for that, it's life changing. I think we can get through this in a couple minutes, and this is probably the last thing we'll be able to get through today before. But
That's no
this is
problem.
yeah, this is just the idea that additional altitude. If you recall from the last meeting, altitude, the pressure put on you by air drops as you get higher in the ozone. Once you hit 30,000 feet, you're in the jet stream, where the natural forces will propel you across the country much faster than you expect. So if you can get to the jet stream, that's kind of what I was saying here. If you can get to the point where your volume is big enough, it doesn't matter the rate, it will throw you in the direction you want to go, because you have pooled benefits working for you, not just pooled risk. As you the ability to cycle through and use your system effectively increases. Um, each time you take a loan, it's kind of the yellow line here, and then you would repay the loan. Treat it just like you would if you were at a bank. The reason for doing that is you enjoy velocity when you take the loan. You, as the business owner, enjoy velocity when you pay the loan back. Two parties here, right? The insurance company receives the loan repayment and then has to go put it to work again, right? So they got this wonderful risk-free rate of return, more than risk-free rate of return, and then went and had to invest again. So they get to add the risk-free rate of return to whatever other investment they had, putting the investment experience way ahead of where they were expecting. At the end of the year, you've done that enough times. It's like, well, what did I put here? Good behavior, you get rewarded with good benefits. Better behavior, better benefits. Best behavior, the best benefits. I can't tell you the exact amount this is going to influence you or your world or your policy. I'm not an actuary. Each company is different. But if you're a good client, like picture a bank, when somebody borrows, pays on time, pays extra, pays with a smile, never bugs, never, like, they reward that. They love that customer. The person who's late on their payments, paid less than expected, paid, like, the person who's calling
Overdrafting
and
the
complaining,
account. Yep.
overdrafting, like, they don't like that. So if you treat your bank like this and willingly, happily pay extra, smile, pay early, they reward that. Um, the reward we're talking about comes from the dividend, right? The dividend is made up of a few things. A dividend is really just a return of premium as classified by the IRS. The dividend factors are mortality, investment, operating expenses of the business. We've got to put our business mindset on to understand this. At the end of the year, the business owners say, well, how did we do? And they say, was the investment experience we expected. Here's what we actually achieved. We're way ahead. Here's the mortality, and here's what we actually achieved. We're way below. We planned on spending this, that was what our budget was, and we spent exactly that. So what do we do with all this extra money? We'll put a little bit on reserve, just in case. And then what? We'll give it back to them. If we didn't need the money to, handle and mitigate the risk we promised we would this year, we give it back to the owners. Who's an owner?
The policy owners.
The policy owner. The policy owner receives the dividend. Um, Man, we can keep going, but yeah, we're just about at 10 minutes past. So I'm okay stopping there. I think there's a couple more concepts to go through, but I don't know if you're willing, I'll come back and finish this up.
That's awesome. So, Joe, yes, I think we do want to come back and finish this up. So we'll have a follow-on part 3 and where you're going. Can you just kind of foreshadow a little bit of where you're going with the rest of this? I think that would be helpful for somebody as they're getting ready to look forward to listening to the rest.
Sure. If we just talked about kind of using the policy, using your system of policies. I don't want to like using the system. We're going to kind of talk about the trade-offs from contract design and really what happens when you choose, like if you go back to the first video, you can design a policy a certain ways. And I mentioned there's trade-offs uh, depending on how you design the first policy, the second policy, how you design your policy can impact what you can do later on. So if you exercise so much flexibility early on, you're not going to have much flexibility later on. And most people actually want flexibility to start and never stop. Once the flexibility starts, they don't want it to stop. So just kind of walking through that and the repercussions, some of the repercussions of if you are short-sighted. Let's go back to this. We're going to apply these in our design. If we're short-sighted, if we act afraid to capitalize, if we don't repay the loans, if we use a bank instead, if we maintain the old system thinking, it's going to have really, it's really going to inhibit what we can accomplish with this. And I think this is why this is such a great, these principles, man, if you apply this to how you design your policy, it really, really helps snap things into focus. So it's more, and again, I'm not going to have illustrations. These aren't going to be numbers really, but it's conceptually what's happening when you choose one way to do something versus another. What are some of the trade-offs we're doing in that decision making?
Joe, I think that's really helpful. And so as I'm going to just take us back to something that you said a little bit ago, and it seems maybe a little bit implausible, the idea that volume is more important than rate. It's more important even than time. And I think that I was just mulling through that as you were talking about eventually, if you have enough volume and you have enough rate and you have enough time, but you're going to get to a point where there's enough volume that it kind of shifts the game for you. And if you can just maybe at a super simplified level, think about the person who has $1 in savings. Well, that's not, you could have a really high rate of return on that dollar and hold it for a long time. You're still going to not, I mean, yes, compound interest, if you double that a day, every day, you're going to get to a point where you get that hockey stick curve and it's going to turn into millions over a long period of time. But you're going to go a long time with having $1 in savings. And then you're going to have $2 in savings. And then you're going to have, you're just going to have a small amount in savings and you're not going to really be able to get to that point that the volume makes sense. But let's just say tomorrow you had $1 million in savings. Well, now you have a lot of options because, well, now you can purchase business or purchase real estate or purchase multiple pieces of real estate. And you have so many more options available to you when you cross some. I mean, it doesn't have to be $1 million, but when you have a volume in your control that you now have substantial decisions that you're able to make that will impact you profitably. And so I just really wanted to encourage that idea that the volume really does matter. I'm sure you
That's
want
so
to
good.
respond to that if you want to, Joe, before we close.
Um, gonna I'm debating if I should share. No, I'll share it next time. But it's this idea that as the volume increases, that your need for capital, like the amount of time it takes for that scale to create the same volume. So like if you take $100,000 to get to $100,000 might take you 15 years to save up. But for that 100 to help you earn the next 100, it might only take 8. For that 200 to help you get to the 3, it might only take 6. By the time you get to 900 to get to a million, it might take 1 year, because the scale is doing most of the lifting. But yeah, it's so good. It's the volume. If you can focus on the volume, and it helps you when you're looking at your budget to say, is this serving me or not? And if I'm serious about shifting because I want control for the rest of my life, is maybe you might have to, look in the mirror and have a tough conversation to say, is Netflix, does that make sense for me? Does Hulu Plus or Apple, Amazon Prime, or does all that make sense for me right now? Or can I forgo it for 2 years? Am I going to die if I don't have that for 2 years? If not, maybe consider redirecting it. And I mean, we can go through this later. There's also a way that you can use the policy as this is happening to still live the same lifestyle. And I think that's one of the benefits. Um, once you create a little bit of free cash flow, you can use the policy to fulfill your lifestyle needs. So you don't feel like you have to sacrifice. And I can give you next time, maybe I'll give you some 2 or 3 ideas on how to do that. Um, yeah, we can just go from there. That's going to be a
Awesome.
great one.
Awesome. All right. Well, if you were listening along, thank you for staying with us through this conversation. I know we had several listeners throughout, several great questions, comments, well, mostly comments, some hearts and love here as well. I don't even know how to do that in YouTube, but that's happening. So thank you, whoever's sharing that. We really love, if you haven't noticed, over the past 7.5, probably, maybe we're at 8 years. I don't even know. The podcast has been live for quite some time, and we have been loving being able to bring you understanding and a way of thinking about your financial life that puts you in a position of control. And this is just an extension of that. And I love the analogies you're sharing, Joe, and just having your fresh insight is really helpful as well. So we are going to continue to do this. Ask your questions. Join us next time. If you want now to start taking action and you are saying, I think I'm ready to start implementing infinite banking, I want to have a conversation about my personal life and look at where I can make some moves right now, whether you're starting a first policy, a second policy, a fourth policy, whether you have questions about a current policy you have, wherever you are in that spectrum, if you're ready to take action, we would love to have you book a call on our advisor's calendar because we want to have that dialogue with you so we can help you be able to intelligently and confidently, with wisdom, take that first step and know how that's going to impact everything else in your life so that you can start making that transition into capitalization, into earning the ability to reap the rewards, into that greener pastures that Joe was so eloquently sharing today. So thank you for being with us on this conversation. And in closing, please remember success leaves clues. So model the successful few, not the crowd, and build a life and business you love.